I'm an independent consultant, not a WFG employee, but I've been hanging around with WFG for so long that I feel like I need to try to add value the way that WFG keeps talking about adding value. I gave an economic forecast a year ago, and I was wondering what I could do to double the value I provide to you relative to what I did last year. So I did what many of you would do in a situation like this. I turned to AI. I said, hey, I gave an economic forecast to these people a year ago. This year, I want to double the value I provide. What should I do? The AI says, give them 2 economic forecasts. Okay, I use a budget AI. It's, I put in a quarter and there it is. But I'm actually liking that idea the more I thought about it. So what I'm going to do is first present my 2 economic forecasts. One assumes that we clear up the... Did the mic go out? Hey, sound people. All right, I'm going to just sort of cruise along here and keep going? Okay. So I'm going to present a forecast that begins with the assumption that we solve the problem with the Strait of Hormuz and get oil flowing and oil prices start to come back to what we used to think of as normal. And then I'm going to give the alternative forecast, what happens if the Strait of Hormuz is closed on a long period of time. I think that will be a global recession. After doing those 2 forecasts, I'm going to talk about where I see real estate going. And then I am going to invite Jeff Lobb up here to give me the questions that have been coming in over the last month, and we'll do a little bit of Q&A. So let me roll on into this forecast. Is everybody hearing me okay now?
Yes.
Okay, good. Under my base case, oh, there we go. Man. But I can deal with change. I can deal with change. Not well, not comfortably, but I can deal with change. So the base case forecast I have has the U.S. economy growing without recession, growing at a pace of about 2% a year. Our long-run historical average for decades has been growth of about 3% per year, and I'm forecasting 2% a year, and let me tell you the difference. The 3% growth in gross domestic product, GDP, inflation adjusted, has come from 1 percentage point of more workers and 2 percentage points of productivity, more output per hour worked. I think we're going to continue to get that productivity increase, but we are not getting the labor force increase. The U.S. homegrown, native-born population of working age, younger than the retiree baby boomers, the working age, homegrown population is not growing. Actually, if you look at the hundredths of a percent, you can see a little bit of growth, but significantly flat. We used to make up for that with foreign immigration. But you know, we have new policies, and the number of people moving in, net of those moving out, is approximately zilch. So our population is not growing. And you might want to keep that in mind when we think about housing too, that we're not seeing much population growth. So without the labor force growth, we'll have the productivity growth, the 2%, and that's what we're going to have this year and next. Now, going from 3% growth to 2% growth is not a recession, it's still growth. And to tell you the truth, most of you cannot look at your P&L and see the difference between the national economy growing at 3% or 2%. But that's the context for that. What's going to happen with interest rates? I ask myself that a lot, and you ask me that. At the beginning of this year, the Federal Reserve anticipated that the job market was going to weaken. There would be fewer jobs, rising unemployment, and they anticipated that inflation was going to come down. Well, we're almost halfway through the year. The job market is healthy. It's not booming, but it's not a problem area for the Fed today. But inflation, yeah, inflation is high. Now, we try to look through some temporary changes. And when I look at the inflation numbers, I see three layers. At the top, the effect of high oil prices, which lead to high gasoline prices. All of you probably drive or feel that. So that's the top layer. The next layer is tariffs, and that has pushed up a lot of prices, but by a fairly small amount. And then the third layer, the bottom layer, the base layer, is underlying inflation pressure. You've probably heard the expression, inflation is too many dollars chasing too few goods. We try to look at that. And the Federal Reserve has studied what to do with tariffs, what to do with oil prices running up, and they have concluded that they should look through those price increases, meaning ignore. If prices go up just because the Strait of Hormuz is closed or just because we have tariffs, that does not justify raising interest rates, according to the Fed, which I agree and most private sector economists agree with. But that underlying inflationary pressure, and we cannot see it clearly because the statistics are all sort of mashed together, but the underlying inflationary pressure appears to be stubborn above the Federal Reserve's 2% target. So what does this mean? I don't think we're going to get any interest rate cuts in 2026. We expected at the beginning of the year we'd see 3. I'm now saying 0. And if I'm wrong, I think I'm wrong in the direction that the Fed may be tempted to tighten, to raise interest rates. My best guess is, I'm sorry, I'm not supposed to say guess. My best estimate, my best judgment is that we will not have any change in short-term interest rates, but we will, the odds are stronger for a hike than a cut. All right, so that's the base case forecast if we solve the problem of the Strait of Hormuz. But now let's move into the bad news. The bad news is very little energy is going through the Strait of Hormuz. When you count the crude oil going out, plus refined products and petrochemicals from the Persian Gulf region, 9% of the world's energy production goes out the Strait of Hormuz, 9%. If the strait remains closed for months, the world has to use 9% less energy. And whether we ration the energy by raising prices, which is what we'll do, or whether we used ration coupons or some other scheme, we have to use 9% less energy around the world, and that will mean a global recession. At the consumer level, people will say, hey, I should drive less to conserve my money because gasoline is so expensive, but people need to go to work, and after they pay for the gas they need to go to work, they'll have less money for discretionary spending, for going out to eat, new pair of shoes, whatever, and that will lead to layoffs around the world. And on the business side, businesses have set themselves up to use production processes that in many cases are energy intensive. They're profitable when energy is based on $60 oil. When we go from $60 oil to $100 oil, some of these businesses no longer are profitable. They cut back production, they lay off people, and that's how we get a global recession. And that recession will impact the United States. I was talking with one of my clients. He's the actually retired CEO of a manufacturing company. And he said, Bill, the United States produces more oil than we consume. We export oil. Why should we go into recession? Fair question. I said, Jack, imagine you owned an oil well, and the Europeans would pay you $100 a barrel plus transportation costs for your oil. Would you sell it in the US for $60 a barrel? I mean, we all love our country. We would like our country to do well. But if the Europeans are paying $100, we're going to sell our oil for $100. So we will participate in the recession. How bad a recession would this be? Let me benchmark it against 2008, 2009. Unless you're really young, you remember how awful that recession was. I think that the recession that we are at risk of would be half as bad, only half as bad as 2008, 2009. So, whew, you can wipe your brow. And the 2008, 2009 recession was especially bad for housing and other forms of real estate. And this recession, the oil recession, would be much milder for real estate. So, as just a sort of a ballpark number, I would think if you review your experience from 2008, 2009 and said, hey, it's only going to be like 1/3 as bad as that, that's maybe a ballpark. And I suggest contingency planning, that you think, hey, what happens if we go into a recession and my revenue goes down? Will you be able to cover your fixed expenses, and how are you going to proceed? So that's the basic two forecasts. So I asked my AI, I said, which of these forecasts is actually going to come true? The AI was polite. The, of course, correct answer is neither of them. Something's going to be a little bit different. But also, the AI does not know about the personality of the leaders in Iran or the personality of the leader in the United States. I don't know. I should have studied abnormal psychology when I was in college, but I didn't know that would be relevant to economics. What do you know? So that's the big picture on the two forecasts. Let me spend a couple of minutes telling you what I see happening in real estate. On the residential side, we are seeing fairly steady number of home transactions. The news reports will say, oh, they were up last month, they were down last month. But if you graph it, you see a lot of little tiny wiggles and a fairly steady line on transactions. Now, our population isn't growing, but it is moving. And we need to build where people are moving to. Florida is a good example. We are not building where people are moving from. Rural Midwest, rural South. So we still need to do some building. And the pace of construction, single family is fairly steady, and I think it will continue to be fairly steady. Multifamily construction is increasing, even though rents, the national average, are edging down, not by a lot, but by about a percentage point. So I think we're probably overdoing our multifamily construction, and we will see that reverse course and start to decline. And if you're inclined to rent, this is probably a good time to be asking for a rent cut. On commercial real estate, it is a very mixed bag. I'll make some generalizations, but knowing your local market is most important. We've had some real problems, of course, in downtown office space, and we're not going to see much construction in most of the country. San Francisco and New York are doing well, but many other cities are doing very poorly with downtowns. But there is surprising strength, even in cities that are generally struggling, surprising strength in suburban office, and especially medical office, or suburban office that can be refitted for some kind of health care. And I think that will be an area of strength. You know, people, I live in the Portland, Oregon metropolitan area, and Portland is not what it used to be. And the people in the suburbs don't want to go downtown. You know, they used to want to go downtown. They don't want to go downtown. So things like title insurance offices and other forms of insurance, lawyers, they're moving to the suburbs, so a suburban office. Retail, the malls are not doing well and are not going to be doing well. There are one or two strong malls in most communities, most metropolitan areas, but that is not the boom areas. The boom is actually strip centers that have facilities that are suitable for activities. It's like we're not buying stuff, we're buying experiences. So yoga studios and Pilates and bar and all the karate dojos, you can just sort of walk from one activity to another activity to another activity. I don't know if we're actually exercising more, but we're going to these places and pretending to exercise. So, suburban retail doing okay. Warehouse went overboard. When the pandemic hit, we said, oh, we're not going to go to stores anymore. Amazon and Walmart, delivery, we're just not going to do stores. And American developers stopped building new retail. And it turns out we still go to stores, but the online activity demanded more warehouses. So developers saw that there was demand for more warehouses, and developers did what developers always do. And what do developers always do? See a good opportunity and then go way overboard, build too much, and now we have too much warehouse space, so that's going to be soft for a while. So I think that on average, we're going to have a fairly stable real estate environment for the next year. In the positive scenario, if we go into that recession, the recession will affect real estate. I don't think it'll be catastrophic, but it'll certainly be negative. The volume of transactions and the prices at which those transactions take place will probably decline. But again, I don't know whether that is the case. My final comment before we get into questions and maybe some answers. My final comment is about the labor force. Sitting at the table chatting with you folks, when I ask, hey, what are your challenges? I hear about hiring, finding people, finding talent. The labor force is not growing. So I have been seeing this happen for decades, but now we've got artificial intelligence that offers the opportunity for greater productivity. We're not there nationally. We're there in a couple of niches. Computer programming is one niche, some customer service stuff. But let me give you a few ideas there. First of all, you're not going to see a growing labor force. The pool of potential job applicants is not going to grow. Step number one, running a business, and I say this to people in all areas. I talk to manufacturers, I talk to bankers, I talk to distributors. The number one task is greater productivity, more output per person, and not by whipping them harder. That is not going to work in this environment. Productivity comes from better tools, which could be AI, better tools, better training, and better management. Managers tend to spend most of their time with the problem employees. What you want to do is spend time with average employees who can be better and excellent employees who need to be retained. So that is job number one, productivity. Job number two is retention. And again, spending time with your good employees will improve retention. The third thing is recruitment, and that helps if you develop a reputation and a lot of word of mouth from your existing employees. So the big picture here is the economy, I think, will be stable with the risk of a recession, and we'll talk about that more in question and answers. And now I think Jeff, my friend, is going to come up. He has been gathering the questions that have come out, and he's going to hit me with the questions.
Let's go. You can see, grab a seat.
Right.
Yes, we gathered a whole bunch of questions from leaders all over our regions, and some are very high level and some are very granular.
Yeah. Give me the simple ones.
Yeah. Well, you know, the first one is about the Federal Reserve. They have a new leader in place, right? They've got Kevin Warsh, right?
Yeah.
So will he or how will he impact interest rate policies? Is he going to make a change, and what does that look like?
Yeah. You know that the president wanted low interest rates, and a year ago, Kevin Warsh said, yeah, he agreed that there should be low interest rates. That was a year ago.
Yeah.
The interest rate decisions of the Fed are made by a committee, 19 people on the committee. They rotate who gets to vote, 12 votes, and of those 12 votes, Warsh is one. So to do anything, he needs to find 6 other votes, and it will be difficult in this environment for him to find 6 votes to cut rates.
Yeah.
But the best argument he can use, which at some point he'll use, I don't think he'll use right away, is that we need to keep aggregate demand in line with aggregate supply. And aggregate supply of goods and services in the economy will go up with artificial intelligence, more productivity, more output per worker, and that will justify lowering interest rates to keep aggregate demand up with the growth of aggregate supply. But I look at the data all the time. I look at the statistics so that you don't have to. And I'm not seeing it. I mean, I know that there are niches really benefiting from AI, but for the aggregate economy, I'm not seeing it. So I think Kevin Warsh is going to have to wait to do an interest rate cut.
And that's usually, obviously, the biggest trigger to a lot of factors in our business here is,
right,
you know, the refi pops or the interesting. So
right,
we always look for those, but he's going to have a hard time.
Yeah, and let me add that the Fed doesn't control mortgage rates.
Right.
But mortgage rates do move up and down somewhat with the Federal Reserve decisions. It's
Correct.
more a matter of global demand for credit, global supply of savings.
Yeah. And you know, speaking of credit, the other question that comes up a lot is, are there going to be any fluctuation in credit scoring or credit into the real estate space? Is it going to be impacted plus or minus with credit ability?
Yeah. What I'm seeing is credit standards on the residential side are fairly stable. There'll be some mortgage originators will be a little bit more cautious, some a little bit less cautious, but generally residential stable. It's commercial real estate where there's a big change.
Yeah.
And, you know, commercial real estate went into some significant problems. First of all, occupancy in many areas went down, and then rents had to fall to get anybody to stay. So the revenue went down, and commercial real estate typically is financed with either a floating rate loan or a loan that reprices in 5 or 7 years. So interest rates went up, and the property owners, I feel a little sympathy for them because their revenue went down, their interest costs went up.
Yeah.
And the first approach was what we call extend and pretend. The lenders would extend the maturity. Okay, this loan was supposed to be paid off in 2023. We'll let you go another year or two, and we're going to pretend that it's good collateral. But the pretending is over. There have been office transactions around the country at a small fraction of their supposed collateral value. So what we saw was the bank saying, yeah, we'll extend, but we need some more collateral. We are going to have tighter credit terms. I think that has happened, and that we are about done with the tightening of credit terms for commercial real estate.
For commercial, we have seen on the residential side, I was getting excited for a while, a lot of creativity with these, buy now, sell later, getting rid of the contingency. It's kind of a new way to do bridge loans without having to do really a bridge. So I thought there was going to be a lot more creativity in there to get people into transactions faster. But obviously, if the rates don't move or the credit scores kind of stay the same, it's going to be how creative can they get within their risk, right?
Yeah, and I think a good thing to keep in mind, I went through an exercise a while back of what would be better for the volume of transactions, real estate transactions. Would you like to have lower interest rates, or would you like to have a strong job market? And the thing that brings interest rates down historically is a lousy economy. In a lousy economy, interest rates go down. You don't want a lousy economy. And it turns out that people having jobs are more important than what the interest rate is. So keep that in your back pocket. You can use that for decades.
Well, the one that's near and dear to our heart is, transactional counts. How many transactions are happening? Because that's obviously where we thrive in, right? So, are we seeing a shift in transactions where maybe less or more, where people are just staying in the homes longer? Are they staying without, like it used to be every 5 to 7? Are we seeing people hanging in a lot longer than the norm?
Yeah, there's been a social change among Americans, and we tend to move less often now than we did a few decades ago. A couple of reasons, and the odd thing is I meet people who live and work in the same county where they grew up. But many of us have grandparents who moved someplace else for a better job opportunity.
Yeah.
But the statistics actually show less wage variation from one place to another these days. So people are not as desperate. The ambitious people are still going to New York and San Francisco, but the everyday people don't feel the desperation to go somewhere for a better job. We have a lot of two-income households, and the old days was the husband would get a better job offer and the wife would move along. Today, one of them gets a better job offer and the other spouse says, yeah, but I don't think I'll get a better job offer if we move, so they stay. And then a third thing is you got some folks doing remote work. They're living in the Midwest doing remote work for a New York company, and now they change to doing remote work for a San Francisco company. They don't have to move. They're still in the same home office. So we're moving less. But the thing that is causing me to rub my chin a little bit is the mortgage lock-in.
Yeah.
So we had 7 months with the average mortgage below 3%.
Yeah, I'm one of them.
Oh.
I'm there.
Yeah, braggart.
Yeah, I'm there. 275, baby. I'm not going anywhere.
There are a whole ton of people with below 4%. Yeah. And it's kind of hard for those people to say, yeah, I'll give up the 3% mortgage and go to 6.5%. But there are still refis going on.
Yeah.
Pat Stone was telling me last week that something like 35% of their transactions are refis, and I'm like, what the heck?
Yeah, well, I mean, the refis come in different little pockets, right? So the goal for us is always be prepared for those pockets, because even if someone did buy in, like there's people that always, there's people that want to sell, and then there's people that have to sell, right? Yeah. Life events trigger, and those that have to sell end up, no matter what the rate is, they're going to buy. I mean, look, we sold homes when it was 12, 13, 14% interest, and when it went to 10, we thought it was magic, right? So people have to sell that will always move. The challenges be the second there's that half a point pop or that these mortgage companies are chopping at the bit to get that refi and get that recycle done. And then obviously we have to be prepared for the influx of that, because that can come in, in groups of 30, 40 orders coming in quick. So it's always ready for it, but we'll still see pockets of that, I think.
That's right. And I think an important message is do not get discouraged by the concept of mortgage lock-in. 1/3 of single-family homes have no mortgage at all. Usually owned by older people, but the older people may need to move into a retirement home. They may pass or just decide to move to Florida. And you've got people with low balances, so they refied, but it won't cost them much to move.
Yeah, or the life event happens and they just want to retire, move, downsize. It's all going to happen.
Yeah.
So I do have a forecast to get my 20-some-year-olds out of the house to buy something, because I told them I was coming to talk to you, and I can't seem to get them the hell out. Is there? So we got to get them moving and buying things.
And if you succeed with that, I've got a couple of 30-year-olds still on my cell phone plan.
There we go.
Anybody here have a person in their 30s, a child on their 30s still on your own cell phone plan?
There we go. Look at the hands.
Yeah, right,
So I don't feel as bad now. I feel better. I still don't really feel better. I'm just going to have to make up something for my kids. But all right. So the other questions that come up are about commercial real estate, big transactions for the title space.
Yeah.
Are there any macro indicators that might impact the movement of it in the next 12, 18 months that can move the needle? Is there something that could happen or will happen?
It's very local, but on the big picture, we tend to get more commercial transactions when times are good.
Yeah.
And if you take a particular segment, say a metropolitan area and a particular property type, when that is stronger, there'll be more transactions. Now, as an economist, I don't understand that. It seems to me the number of transactions should be the same. But sometimes I look at the data and say, I don't understand it, but that's what the data show. So the stronger sectors will have more transactions. But we're seeing a minor exception to stronger, more transactions. And that is that some of the troubled real estate is starting to move. So I talked about extend and pretend. Well, many of the property owners, the investors who have property around the country, would buy high quality properties. They would hire good local property managers, and they just sit and collect the proceeds. And then those values went way down. And now they're saying, okay, we tried to pretend that we had good property. Now we don't. This is not the appropriate property for us. We need to sell it to a bottom fisher turnaround guy. And so we're seeing an increased number of big properties selling. So in terms of transaction count, that's good. In terms of dollar value of the transaction, it's bad.
Yeah.
Because you make, as far as I understand the business here, when the price is 80% lower than it used to be, the revenue is like 80% lower than.
Yeah, market value drives downward. Sure.
Yeah. So you get the transaction.
The numbers have to
You're
make
doing
sense.
as much work.
The positive thing I've seen in some, maybe you've seen this in some commercial markets though, which I've been encouraged by, is the repurposing of some of these big spaces, taking the mall that now is vacant because they can't sustain retail,
right,
and converting it into other things, which hopefully brings the economy in those local markets back.
Yeah, and I'm seeing that in a couple of regards. In some areas, it's office becoming residential, and malls are becoming a mixed use with some residential, some remote work office space. But I still think that's a tiny fraction of the whole market.
Right. Okay. Let's shift to the residential side for a bit. The industry has seen a ton recently this year of mergers and acquisitions, big companies, Remax and Real, and the EXPs of the world acquiring other companies, and these big companies coming together to form theoretically a better cost structure, theoretically lower their overhead to be able to be more efficient. Now they're all trying to be in that mortgage and title space as well. They're all trying to get a piece of that pie because in many cases the real estate business overhead sometimes is not as profitable. They're not. So they look to that mortgage. These big consolidations that are happening, you see that it's going to impact the title agency business or the title business at this level versus the corporate level? Because everyone's trying to get a piece of it. Are they going to really take some of it from us?
Well, I think of a number of very closely related businesses. So you got the brokerage, you got mortgage origination, you got title, you got escrow, and I don't understand all this stuff. But 20 years ago, 30 years ago, if there were two companies of equal size and they merged, the merged entity would have costs that were like the sum of the two prior companies' costs. But today, IT and compliance is a bigger portion of costs, and those don't get added when you merge two companies. You can spread the costs. Maybe they increase a little bit. So by merging, you spread IT and compliance and maybe some other costs over a wider base, and you're more profitable, and that drives mergers. And I think that will continue, and that will be a dominant theme with the exceptions. And the exceptions will be smaller companies that succeed in competing against the big companies, and this is how they do it. Every large corporation has at least one bad regional manager. I mean, maybe not a bad human being, but an incompetent. I have been a corporate employee, I've been a consultant to corporations. Every corporation has a bad regional manager. Every corporation has big corporation has a stupid corporate policy that doesn't work for some particular niche in some particular market. And the large corporations tend to be slow to fix their problems. The small businesses, and that could be medium size as well, are more agile. They fix their problems or they go bankrupt.
That's it. Yeah.
So there will be the little guys continually grabbing some market share from whichever of the big guys has the bad regional manager. You can't count on that happening all the time, but there are some independent outfits that do a pretty good job at finding the weak one in the herd.
Links, yeah. I'm just curious, is there a concern from this group here in this room about some of these large companies now trying to capture more mortgage and title business at the large levels? Is that a concern? Yes, yes, no, no. Yes, yes. I want to share a couple things I've seen over the years, if you don't mind.
Yeah.
So, and very similar to your
And
thoughts.
then I'll come back to a comment.
And just very similar to, we've seen a lot of mergers and acquisitions over the years. Yeah. And usually what happens is there's a lot of good PR that comes forward-facing. It looks magical. And I've sat on many calls where we always hear, hey, we're going to continue to operate as usual. Nothing's going to change. Our brand is going to be the same, all that. Next thing you know, there are obviously cuts and movement and management colliding. But at the end of the day, for what I think I've seen, even in the tech space, trying to merge all this stuff together and get it to work takes several years. And it's complicated, there's no innovation, it gets stale, and decision-making can't happen fast. No. So to me, being more nimble, higher level service, responsive, is gonna take all that business and outshine the big companies. Yeah. And let's face it, the loyalty sometimes in the real estate space is usually not loyal to the company in many cases. I hate to say it, but that's the truth. They're loyal to themselves. Like I have my own title people, not the broker's title people. So those relationships that drive deeper in the community are still gonna win you the business, regardless of sometimes the corporate hierarchies. So.
Absolutely. One of my past clients owned, 6 or 8 different businesses, borrowed money, and he said, I have no loyalty to a bank, but he named 3 individual bankers that he was loyal to. And he says, I don't care what bank they work at, I'm working with Bob and Peggy and somebody else. The other issue, as we talk about one company doing all these functions, is that I saw it in the banking and investment banking area. I'm a guy and I want to serve, let's say I'm a bank loan officer doing business stuff, and my corporate boss says, hey, you should cross-sell to the trust department, cross-sell to deposits and cash management, and my compensation comes from serving the loan customers. And if I think my trust department is not up to snuff, I'm not going to send my customer there.
Interesting.
So you may find in real estate that the cross-selling doesn't work as well. It can work, but you got a lot of silos to overcome.
Yeah, that's great. So Most of our day is going to be on AI, so I'm going to save some of the AI questions for the AI world after this morning session.
Good.
But there's a question that in the media, when you read the media all the time, I see that, you know how they are. They're always trying to get attention, right? So they say, you know, when's the housing market going to get back to normal? Get back to normal, right? And I look up, I'm like, what the hell is even normal? There is no such thing as a normal, right? What is normal? So in your perspective, where do you actually see what normal might be in your world? And then how do we prepare for anything that might shift us there?
Yeah, that's a good question. In fact, I liked that question. I actually heard it last week and had time to think about it, which makes me sound like I know what I'm talking about.
Yes.
And I started looking at the data, and I've got an article that will come out on Forbes.com next week on this. And what I saw was a period of time. I'm looking at residential transaction volume. And it was growing fairly steadily. Some years would be strong growth, and next year a plateau. But you know, you blur your eyes from short-run fluctuations, and you see steady growth from like 1968 until about 1980, when Paul Volcker at the Federal Reserve said, "Let's stop inflation," and mortgage rates were over 16%.
Yep.
And housing got clobbered, and it just crashed. So it had been steady. It felt normal to the people in the business, and then it crashed.
Yeah.
A few years later, transactions started growing in pace with the overall economy. It felt normal. And then in the early 2000s, like 2003, transactions shot up, and new construction shot up. That felt good, except people were not buying houses to live in, they were buying houses to flip.
Yep.
And we ended up with the Great Recession, and it was colossally bad.
That's right.
And then by about 2011, 2012, it started to get that normal growth with the overall economy. And then the pandemic hit.
Right.
And that was a surprise, but it was an upside surprise for real estate transactions.
Oh, yeah.
So here's my definition of normal: steady, calm growth, and then something huge changes that nobody expected.
Okay. So you had a great analogy from your book. So
Yeah, you're right. So you need to be ready to operate in that environment, but you also need to be ready for disaster. So I wrote a book called The Flexible Stance about dealing with the economic fluctuations if you do not trust the economist's forecast. And let me do a little demonstration here. Imagine a baseball game, and a fast runner has gotten onto first base, and this fast runner wants to steal second base. The runner does not get into a sprinter's stance because there's a chance the pitcher's going to try to pick him off. So he takes a stance, a flexible stance. He's ready to dive back to first base, but ready to go forward and steal second. That's the stance businesses need to take when they're uncertain. You need to be ready to go in either direction. So I would suggest that a base plan in sort of steady times is, hey, let's look at the last couple of years, let's be ready for that, but also do a contingency plan. Things could go down, things could go up, and how can you be resilient and flexible to take advantage of whatever comes?
Yeah, I mean, I know even some of our real estate clients we work with, we have a plan that if transactions go down to X numbers, here's how we pivot.
Yeah.
If we go up, here's how we grow, but not overgrow too quick and have overhead killing you.
Right.
So you have to have both plans because that's just going to be the economy.
Yeah,
right?
absolutely.
That's how it's going to go.
Absolutely.
So I love that positioning.
So normal with a big surprise that nobody sees coming.
Always be prepared. Yeah, always be prepared.
Right, yeah.
Time-wise, we're ready to wrap up. Is there a final thought to share with this group? Something maybe to look forward to, or what are your...
Yeah, let me take a broad perspective. I've been doing this economic stuff for a long time, and I love looking at the history. And right now, people feel highly uncertain. Yeah. There's a lot of worry. We see that there are some people in economic difficulties. You know, our heart goes out and we wonder about it.
Yeah.
But we've always been uncertain. I've been doing this for a long time. We've always felt uncertain. And what has happened is people get up in the morning, drag their rear end out of bed, and they go to work.
Yeah.
People go into the office and say, hey, I think there's a better way to do this. And as a result, we live far, far better than our grandparents do. And I think our grandchildren are going to be better off. They'll be taking advantage of AI. They'll be living healthier lives, longer lives. I think that we have a great future ahead, but there'll be some challenges along the way.
Fair. Thank you so much for your time. Really
Thank
appreciate
you,
it.
Jeff.
Thank you. Thank you. Thank you, Bill.